Hello, welcome back. Learning objective number 3, compute and report interest on notes receivable. So far in this chapter 8, we have been focusing on accounts receivable. So how about some of the common accounting treatment of notes receivable? So that's the topic of this section. Notes receivable and interest revenue. So we're going to recognize notes receivable and also going to see how are we going to recognize interest revenue. We mentioned the differences between accounts receivable and notes receivables early on. Accounts receivable most likely are generally interest-free, when notes receivable charge interest from the day they're created to the day they're due, their maturity date. So in calculating the interest on notes receivable, we need 3 pieces of information. We need the principal, which is the amount of the note receivable. We need the interest rate, which typically is expressed as the annual interest rate charged on the note. And then we also need the time period for interest calculation purposes. So as we're going to see in our example, be careful with the fact that the interest rate is often expressed in annual interest rate when notes receivable, oftentimes the time period is expressed in month. So there's a difference, of course. So for example, let's look at a few examples. Let's say we have a note receivable that has a principal of $10,000. In fact, all 3 are 10,000 just for the simplicity of the calculation of the interest. Let's say, notice all have a 6% annual interest rate. The first one will mature in 2 years. So for this period that we are interested in for the current period, because it will mature in 2 years, if we're calculating the interest earned for this year, we use the principal amount of 10,000 times the 6% annual interest rate, and then we can convert the 12 month into a year, because 1 year has 12 months, so that's 1 year. So that's how we get $6,000. In the next example, we have the same principal amount, we have the same annual interest rate, but it's only 10 months. Again, we have to convert the 10 month into a year. So we have the principal of 10,000, 6% annual rate, and 10 over 12 year. That's $5,000 if you do the calculation. The last one, the same principal amount, interest rate, maturing in 2 months. That's 2 months divided by 12 months in a year. We get 2/12 or 1/6 of a year. That's how we get $1,000. So that's the first thing we need to be careful with in calculating interest. Is the rate is annual, and the time often is expressed in months, sometimes in years, so you have to be careful. And sometimes, as in our previous example, this note receivable is mature in 2 years. However, we accountants are not going to wait until the end of 2 years to record the interest rate. Remember, the balance sheet, the income statement typically are produced at least every year. So at the end of the first year, we're going to recognize the accumulated interest revenue. Remember, we recognize revenue does not necessarily in the same time as we receive the cash payment. The cash payment will be received in 2 years, but we're going to recognize the income revenue that's expected in the future now at the end of the first year. So that's what this diagram is about. So let's say we created a note on November 1st, 2008. Between November 1st, 2008 and December 31st, 2008, we have 2 months. So we're going to recognize revenue from the interest or interest revenue for those 2 months first. That's the end of the year adjusting journal entry. And then we're going to recognize the second half, which is the 10-month interest in the year 2019. So we have a note receivable starting from November 1st, 2018, annual interest rate 6%, amount of the note or the principal is 10,000, so maturity date of the note is November 31st, 2019, that's 1 whole year, and the company's end of the fiscal year is December 2018. So which is basically the same fact. When we create the note receivable, we debit note receivable, which is an asset, increase on debit. We loaned cash out to other people, to outside partners, customers, so that's cash decrease. That's easy to understand. And the second is we have to accrue the interest earned at the year end, December 31st, 2018. Be careful here, we're only accruing for the 2 months of interest income that has happened and we have earned. So principal amount 10,000 times 6% interest annual rate times the 2 months divided by 12, convert that to 1/6 of a year. So we calculate the interest revenue will be $1,000. So if we do a journal entry for that, interest receivable, which is an asset, is $1,000. We also recognize interest revenue of $1,000. Revenue increase goes on the credit side. By the time October 31st, 2019, the note receivable is mature. So we're going to recognize the 10-month interest revenue that happened in 2019, principal times 6% annual rate times the 12-month total. That's the total amount of interest payment in cash we're going to receive. However, we have recognized the first 2 months in 2018. So we're only going to recognize the 10-month, which is $5,000 of interest revenue for 2019. So let's look at the journal entry. We calculate the amount of revenue that's interest revenue need to be recognized in 2019. That's principal times 6% times 10 months out of 12 months, so that's $5,000. If we do a journal entry, on that day, October 31st, we received cash payment for $6,000. That's for the interest on the note receivable. 1,000, that's the receivable from the previous year, from 2018, and 5,000 is the revenue for the current year of 2019. So 6,000 has 2 parts, has 1,000 receivable and 5,000 interest revenue. We also get our principal back. So we get cash, debit, 100,000, and note receivable, 100,000. Basically, just reverse the record or the journal entry we did when we issued the note receivable. Now we reverse it back when we receive the cash payment. Last topic, very quickly for the chapter, we're going to look at the receivables turnover ratio. So basically, we're keep using the receivables as in another term that we're not going to dig too much deeper into is working capital. So basically, we have the amount of receivable which conceptually as if we loaned customers some money so that they can buy from us first and then pay us back later. And then we use the money to be loaned to the next customer and next customer and so on and so forth. So the higher the receivable turnover ratio is, the faster the collection of receivables is, which generally speaking is a good thing. And alternatively, we're also going to use the number of days in a year and how many times receivables turn over in a year to calculate the dates to collect. That's a different concept. So number of days in the year divided by how many times receivables turn over in the year give us how many days we need to collect our receivables. So let's look at an example. Also look at the formula we're going to use to calculate those two ratios. The receivables turnover ratio equals net sales revenue divided by average net receivables. So if we know that the net sales revenue is $500,000, and if we know the beginning net receivable and ending net receivable, typically we just add those two together and divide by 2. Let's assume the result is 50,000. So 500,000 net sales revenue divided by 50,000 average net receivable, we get 10 times. So in an average year, our receivables turn over 10 times. Days to collect equals 365. We have 365 days in a year. Divided by receivable turnover ratio, which is 10, we get 36.5 days. It takes, on average, 36.5 days to collect accounts receivables. As we mentioned, this is a useful, those two are useful financial ratios to compare the company with your competitors, with your industry. So, for example, we have some examples here. Look at Apple, for example. Apple's turnover for 2016 is 13.2 times, which equals to how many days to collect? 27.7 days to collect. So that's a performance measurement that you can compare your own turnover ratio and days to collect, this year with previous year, with last year, with next year. So 2016 when it was 15, with 14 to see any trends. And also you can compare your numbers with your competitors in the same industry. So if you have another company post that the turnover is slower, is faster, a little bit faster slightly, and then it takes them a little bit less days to collect. So as we mentioned, it's always a good thing to have faster turnover and to have less days you need to collect. So you can sell your receivables by factoring, and that's one way to accelerate receiving cash, or you can use credit card so that you don't worry about collecting cash.